This new 5% down payment for multifamily homes like duplexes and up to like 4 units, it's a huge game changer because it makes it more accessible to people that are trying to get into real estate investing, or even just help with those housing costs by helping lower them, because you can house hack these properties and live in one and rent out the other side, and that is a huge help. Hola, welcome to the Money Chisme podcast. I am your host, Violeta, a first generation Mexican immigrant. I am a real estate investor and business owner, pero let me tell you, just like other first gens, I was not taught much about personal finance. And I mean, needless to say, I was bien perdida. I was so lost, and I struggled a lot in my personal finance journey. And that's why I created the Money Chisme podcast, where each week I bring you the chisme on how to manage and grow your money and other money talks to help you to kick ass with your finances. All right, so let's get into this week's Money Chisme. Hola, hola. Welcome to another episode of the Money Chisme podcast. And this week, I want to talk about this new requirement that Fannie Mae came out with. And if you've been following me on my Instagram or my TikTok, you kind of maybe already saw what, about it, a little bit about it. So I want to go into a little deeper of, what Fannie Mae's new 5% down payment for multifamily homes, what it is, what's about, and how you can use it to get into real estate investing and start building that multiple sources of income, build that financial freedom, and start building that generational wealth. So as you know, I am a real estate investor, and I advocate for and try to motivate others to start real estate investing, because it is one great way to start building that wealth, especially with those multifamily properties. But, especially now with like these interest rates and all that stuff, it could be, out of reach for a lot of people, because sometimes you are required to have, like that 15 to 25% down payment, especially for the multifamily properties, along with some other requirements. And so it can make it hard for someone that is like trying to get into it. It could set them back, because now they got to wait and try to save up for not only the down payment, but the other requirements that sometimes you have to deal with when you are looking into purchasing something like a multifamily home. So first things first is, who the hell is Fannie Mae? Well, Fannie Mae is actually a kind of government-sponsored enterprise. They used to be, just like a company, but then the government kind of like took it over. But basically, they buy mortgage loans, and they give a guarantee for those loans, which, the lenders because then that means it reduces their risk, because now the loans that they have, that they give out, they're backed by Fannie Mae, and it makes these loans a little bit more attainable and a little bit affordable, because Fannie Mae is backing up these loans. So Fannie Mae themselves does not, they do not originate loans or lend out money themselves. What they do is they acquire these mortgage loans that are made by other lenders, and then they give out these mortgage backed securities, and that ends up attracting investors. So that's how they are involved, and by doing so, they can help get products out there that helps loans become more affordable and available. But they still have like their own requirements that they put out on what they will accept and stuff like that. So that's the basic gist of who Fannie Mae is. So why the change? Like, what's up with Fannie Mae? Porque all of a sudden are they switching up from asking 15 to 25% of a down payment for a multifamily home, then going to, asking for 5% down payment? Well, apparently, they want to help combat the, housing affordability issue that we're dealing with today. And, they understand it's like crazy and it's really hard to, purchase a home and be able to afford it. So they want to encourage people to go for multifamily homes and have that option to be able to buy a property for them to live in, but also be able to house hack it and, not only one, reduce their, housing costs, but also, provide housing for other people and hoping that it's going to make housing more affordable and easier to get. So with that, they decided to lower down the requirement for a multifamily home to 5%. Now this is going to come into effect a little bit after November 18th, but you can actually start looking into it and trying to figure out if you will be eligible for this loan. So you can start reaching out to lenders and start learning about this new requirement. So let's talk about the new requirement. What does it apply to? Are you eligible? What's the details? So far, there's a few things that have come out. Like, as far as eligibility, you still have to meet, there's certain loan criteria like credit score, your debt to income ratios, and you still have to have financial reserves, depending on if it's like a 2, 3, or 4 unit property. And that basically just means that you have enough of kind of like an emergency fund of like 1, 2, or 3, or depending what it is, sometimes even 6 months worth of financial reserves in case something happens. So you might still be required to do those things, which is why it's like you can start reaching out to a lender and start figuring that out. So for the property types, this loan is going to be for like 2 units up to 4 units. Multifamily homes like a duplex or like a triplex, or even a small apartment that's, has 4 units. Now, the thing is that you do have to live in these properties. So it's not meant for an investor that is looking to buy a property that they're not going to live in. Because again, the goal of, Fannie Mae with this reduced down payment is to make housing more affordable and to help reduce housing costs for people. So this is for house hacking, which house hacking is basically you live on one unit and then you rent out the other units, and that's basically house hacking. So what about the self-sufficiency test, which usually applies with like things like the FHA loan? And with this one, apparently it's not going to be required. And self-sufficiency test is just basically means that they want the property to have a positive cash flow. But with this 5% down payment, it's not required, meaning that you don't have to have a positive cash flow, because again, the goal is to help reduce housing costs. So you could get into a duplex or whatever and you pay half, and the other unit may just make enough to maybe half your mortgage or pay some of it, but you're not necessarily having a positive cash flow at that time. And, some people just want a multi-family home to, maybe live on one side and maybe like their parents live on the other side, or maybe their kids. They want to do a multi-generational type of home. But sometimes it was hard to try to get a property like this because they had to have that self-sufficiency test where they had to show positive cash flow. And here it's not going to be required. So that's a positive. All right. What about private mortgage insurance, PMI? This is an insurance that you pay on top of like your mortgage payment, because you put less than 20% down on a property. Now with an FHA loan, you can buy a property with as little as like 3.5%, I believe. And, obviously that's less than the 20%. So a lot of people will pay PMI. Now, the problem with an FHA loan is that you are going to continue paying that PMI throughout the life of that loan. So as long as you keep that FHA loan, you're going to keep paying that PMI. There's no way to like really get rid of it, where unless you switch over to like a conventional loan, or in this case, even though you're going to pay PMI with the 5% down payment from Fannie Mae, once your loan to value drops down to 80%, or basically that means that you have 20% of equity in the property, then you could drop that PMI. So another great thing is that you're going to be able to use rental income to be able to qualify for the loan. So once you find a multi-unit property, let's say you find a duplex and one side is already rented out, you can use that rental income to help you qualify for the loan. Now, they're going to deduct a 25% from the rental income for vacancies to account for that. But that's still very good because that will help you qualify by using that rental income that it's already doing. So this new 5% down payment is a great option, but I know there's two other options that are out there. And so like, how does it compare to this new requirement? And, I'm not going to get too into each one. So I'm just going to briefly kind of like compare them. And that's the FHA loan that you can put as little as 3.5% down. And then you have the VA 0% home loans. And those two are also great options. However, with the VA home loan, you could put 0% down, and I actually used it 3 times already. And you can buy a multifamily home. I think it's up to 4 units as well. The problem is with that one, you do have to be a veteran and or active duty. So if that does apply, that is a great option. But if you aren't one of those, then you still can use the FHA loan. However, again, like how I mentioned earlier, is you have some cons where you will pay PMI and you can't get rid of it until you kind of like refinance or go into another loan, like a conventional loan. The other thing is, and it's actually the same with both the VA home loan and the FHA loan, is that you're kind of limited on the types of properties that you can get. Not to mention both the VA home loan and the FHA loan, they have like a lot of extra things that they want you to get, like that you have to require. Like, for example, you have to have a termite inspection, which, in my mind, it's a good thing. But whenever you go buy a property, and especially when houses were flying off the shelves, that was one of the things that kind of like deterred sellers from, selling their properties to, someone that had an FHA loan or sometimes even a VA loan. Luckily, I didn't deal with that because, especially with this house, like, the guy was a veteran as well. And so it kind of like actually benefited me. But, whenever the houses were flying off the shelves, they saw FHA loan and they were like, no. And so with that, with an FHA loan or a VA loan, you're limited, on the types of multifamily properties that you can get because they have to meet certain criteria. You have to take extra steps and all of that. So with this new down payment option with the Fannie Mae loan, then you could get a little bit more of leeway on how distressed a property can be. Now, still not going to be able to like get like one that's like falling apart, but you'll be able to get a fixer upper easier and, start building that appreciation as well as you rehab it, you fix it up, right? So one of the things that I've been seeing like on social media as people start posting about, this new 5% down is, the idea is like, okay, you're putting 5% down, like that is going to have you underwater. What about the mortgage payment and stuff like that? And the thing is, you have to understand what your goal is. Because again, the main goal of this, of Fannie Mae lowering down the requirement is to give opportunity for people to buy a property like a multifamily, like a duplex, and they can use that to help reduce their housing costs. So if you're thinking it of that way, and even if you want to, again, like earlier I said, that maybe you want to do a multi-generational home, you buy a duplex, your parents live on one side, they pay for that, and you live on the other side and y'all split the mortgage, that could be a great option. Now, for those that are looking to get into real estate investing by, house hacking a multi-family home is this still a great option? And in my opinion, like after, doing some quick math, I can see, making this work is just, understanding and doing your homework of, what your market looks like, what the properties that are available in that area are, and, what you are willing to kind of compromise with, because to make this work, you might not get a nice, good property. You're going to have to get maybe a distressed property that you're going to have to put some work into. Or, it might not be in the best neighborhood or your ideal neighborhood that you're looking into. But again, this is a property that, you just, suck it up for like a year, whatever the requirement is, right? I'm assuming it's a year just because that's usually the case, right? And, just doing your homework and running the numbers, which, by the way, I do have a property calculator, a rental property calculator that can help you figure this out. And I'll link it in the notes, which is what I use to kind of figure out this scenario. So let's use one of my duplexes that I purchased for 113K about a year ago. And you might be like, it's a duplex. It's a 2-bedroom duplex, 2 bedrooms on each side. And you might be like, well, 113K, like, come on, I'm not going to find that. In the area that I'm investing in, that's kind of like, you could find those. I mean, I looked yesterday trying to find, because I'm always looking in the area. And they're about 120K but with this one, it was the same thing. It was listed for 124K, and I brought it, I negotiated down to 113K. Now with this duplex, let's say I was at the 8% of interest that is going around about average right now, and I put a 5% down payment, like I am still good. And again, with the scenario, you have to live in the property. Now, again, you do have to make some, compromises, and these duplexes, are older. They need some repairs and stuff like that. And, it's not in like the best neighborhood. It's not like the worst neighborhood. It's just like an average low income neighborhood. And so taking that into account, regardless, in this market, I can charge, these duplexes are 2 bedrooms, 1 bath on each side. And I can charge, up to, I think one of them is like almost 900. For this one, I think I'm charging like 850. But even with 5% down, 113K that I paid for it, and an 8% interest, me living on one side, it only puts 334, about $350, let's say, out of pocket that I have to make up for the mortgage. And this is including like vacancies if the other side is not rented out, and it accounts for like the repairs and stuff like that. Now, it doesn't account for a property manager, because assuming you will be managing the property since you live there, right? And then, some of the repairs I put just like a 5% repair, because you live there, you're probably going to be doing some of the maintenance and the repairs, right? But all in all, accounting for all of that, doing something like this, that's going to be like $350 out of pocket for yourself. And I mean, where can you live for $350, for a 2 bedroom, 1 bath, apartment? And even if you want to do it even better, like you get a friend to rent out the other room, and then you could even make up those $350. Now, let's say you live in it for a year and then you decide that you are going to move out and do the same thing again with another property. Or let's say you stay like a year or two or whatever. Even that way, once you move out, you rent that unit that you were living in for another 850. So each side is 850, right? You're still now going to make about $380 of cash flow after like expenses. It's still assuming that you're going to be the property manager since you're in the area. But still, you're still cash flowing, like you're still having a positive cash flow even in this scenario. So don't let the high interest and don't let the idea that you only see a 5% down payment deter you. Now, if you download the calculator, you'll notice that I don't include PMI, and that's just because as an investor, I am required to pay at least 20%. So then I don't end up paying PMI anyways. And that's the typical case for an investor that's not living in the property. But in this case, you could add like 20, $50 per month on top of your mortgage. And so let's say instead of the $350 that I was talking about that you would pay out of pocket if you lived on one side, let's say it's $400 that you pay. That's still a really good deal, living in a 2 bedroom, 1 bath for $400, and you're saving all that extra money to either travel, to save up for another 5% or whatever for another property, so you can do this all over again. That's still a good deal. And once you move out, let's say in my case, rent out that unit that I was staying at for $850, instead of the $379, $380 that I would cash flow, let's say it would be, $350 or whatever. And again, you could take advantage of, the ability to buy more distressed properties. So you might, I saw a duplex the other day it was like $70K, and it wasn't too bad. It needed like new flooring, new tile and stuff like that. But overall, you can appreciate the property a little bit as you fix it up. You got it for cheaper, but the rental market is still like $850 and above. Like, all these things you have to take into account, and it's reducing your housing costs. It is getting you started in real estate. You're getting a property that is, if you're living in it, is getting, like over 75% of it being paid by a tenant on the other side. And then when you get out, it's, 100% paid by the tenants, and you're making money off of it, and then you go and do it again. And so that's the idea of how you can use this to your advantage and start getting to real estate, building that, those multiple sources of income, building that generational wealth. And, don't get scared off by these 8% and interest rates, and seeing that 5%, down payment, and being like, oh, I'm going to be underwater. You just have to know your market, know the properties, figure out how much rent you can charge. And even in your area, you can start looking into that, because yeah, you might say, okay, I bought this property for $113K and I'm renting out for $850, but my area, let's say, in my area that the duplexes are like $250 or $300K, but you can charge like $1,300, so like you got to remember that as well, that even though I'm saying I bought a duplex for $130K and renting out for $850, that's my market. In your market, yeah, it might be pricier, but you might be able to charge more rent, and then plus you're living in it and reducing your housing costs and all that stuff. So really you have to take into account everything, right? And like, to me, this is a great option. Like, I'm kind of happy about it, that this is going to make, getting into real estate investing more achievable and more affordable. And that's what I'm all about, is trying to get mi gente to get into real estate investing so we could start closing that racial wealth gap and building generational wealth for, our future generations. So yeah, if you are looking to get into, investing with your first property, like, this is a great option. And again, it comes, I think it starts November 18th when you can start applying. But, again, you can start reaching out to lenders and start figuring out what you need, what the requirements are, stuff like that. And you can even start looking, like, I stay like almost daily when I'm like at work bored. I just, scroll and try to, look for properties and stuff like that. You can start seeing what's out there and start getting an idea of what you can get. Start looking at the rental market in your area, and like, if you need help, you can reach out to me. I do have a course that walks you through all of this. And again, don't forget to get the free rental property calculator that can use as a tool to help you figure out if it would be a good option. So I'm excited that we have another option out there that's going to make this more accessible and more affordable to be able to get into this. So overall, I'm excited. Hopefully I see people start taking advantage of this and making it work for them. But other than that, I will see you in the next episode. Bye. Thank you so much for listening. If you enjoyed this episode, please rate and share so others may find this podcast. If you'd like to be a guest on the show, you can email me at info.moneychisme@gmail.com. And don't forget to follow me on all my social medias that are listed below. Hasta la próxima. Bye.